Michael Burry bets against Nvidia. Is this the start of the great AI unwind? The Big Short legend Michael Burry has set his sights on a new target, Nvidia. With a $1.1 billion bet against the AI giant and other tech highflyers, this could become one of the biggest stories in the US stock market by year's end. Many remember the movie The Big Short, which chronicled how a few investors profited from the 2008 subprime crisis. Now, Burry's every move is closely watched. So, what's the logic behind his bold short against Nvidia? His recent filings reveal $111 million in put options against Nvidia and a much larger position against Palantir. His reasoning is straightforward: he's betting on an AI bubble. The critical question is, does an AI bubble actually exist, and if so, how big is it? Let's look at the numbers. Nvidia's latest revenue stands at $100 billion, yet its market cap has soared to $5 trillion. This puts its PE ratio at around 60. Palantir's is even more staggering, exceeding 100. By traditional measures, these valuations are exceptionally high. Some might argue, is 60 really that high? Don't we have companies in other markets with P/ES over 100? However, compare Nvidia to other US tech behemoths like Microsoft and Apple. You'll find that most mega-cap companies maintain stable P/ES in the 20 to 30 range, even during a bull market. Nvidia stands almost alone as a giant with such a high multiple. The market has granted Nvidia this premium for a key reason: its unprecedented profitability over the last 3 years. The explosive AI boom created a severe shortage of high-end AI chips, and Nvidia's deep technological moat forced almost every company pursuing AI to buy its hardware. In this unique scenario, a PE of 60 could seem somewhat justified. If this is a bubble, it's still modest compared to the dot-com bubble or Japan's asset bubble. But history teaches us that any disruptive technology undergoes significant volatility before widespread adoption. This doesn't mean the industry collapses, but growth slows. Factors like rising competition and macroeconomic shifts can impact the entire sector. A critical warning signal is now flashing for the entire US stock market: the cyclically adjusted price-to-earnings (CAPE) ratio. This metric, which smooths out earnings over a 10-year period, indicates long-term market valuation. The historical average for the US market is 16.45x. It bottomed at 4.78x and peaked at 44.9x, precisely at the height of the 2000 dot-com bubble. Do you know what it is today? 41x, alarmingly close to that all-time high. It's this very metric that has prompted Warren Buffett to amass a massive cash pile. So, we can conclude that Burry isn't just shorting Nvidia, he's expressing a deep concern about the overall valuation of the US stock market. The very AI darlings, like Nvidia, that have fueled this bull run would be the most vulnerable if the bubble were to pop. The immediate question is, will Nvidia and the US market crash tomorrow? Not necessarily. Successful short plays historically don't unfold in days, they take 6 months to a year or more. During the subprime crisis, Burry placed his bets over half a year in advance and endured significant paper losses along the way. Furthermore, shorting a company doesn't mean it's doomed. Most short selling is a short to medium-term tactic. In the long run, Nvidia's technological moat and robust profitability remain intact. Companies like Microsoft and Apple also survived the dot-com bust and emerged as trillion-dollar giants. So, how should we view the shorting of Nvidia? It ultimately comes down to your investment horizon. Are you seeking short-term gains? Then understand the real risks of a potential correction. Are you a long-term value investor? Then focus on the company's enduring fundamentals beyond the current market frenzy.